that commercial banking loans actually create deposits, not the other way around.
That is correct. When a bank extends a commercial loan, it does not go down into a vault to fetch existing cash.
Right.
Nor does it transfer funds from another customer savings account. It simply credits the borrower's account. And by doing so, it creates fresh purchasing power out of thin air.
Just keystrokes on a computer.
Exactly. The bank expands both sides of its balance sheet simultaneously. It creates an asset, which is the loan, and a liability, which is the deposit. Perry Merling emphasizes this exact mechanism as the foundational core of modern credit.
So if a business takes out a loan to, say, build a new factory, the bank is essentially conjuring the money for that factory into existence.
Yes. And this leads to a critical point Professor Werner makes. The macroeconomic outcome depends entirely on where that newly created money goes.
Because all money creation isn't equal.
Precisely. If this new money funds productive business investments, think new technologies, infrastructure, or tangible goods and services, it adds real value to the economy. Historically, we have seen this approach in countries like Germany and various East Asian nations during their periods of really rapid growth.
So when new money chases a growing supply of real, tangible things, it generally leads to a stable economy with low inflation.
Exactly, because the supply of goods is rising alongside the money supply. But if that newly created credit flows elsewhere, the outcome changes completely.
For instance, if banks primarily lend to fund pure consumption, you suddenly have more money chasing the exact same amount of goods.
Which naturally drives consumer price inflation. And then there's a third scenario, which is highly relevant to modern financial systems.
Asset purchases.
Right. What happens if this newly created money primarily funds financial transactions or asset purchases? You are giving investors new purchasing power to buy existing assets, like real estate or equities.
And that creates asset price inflation. The prices of homes and stocks go up, enriching the people who already hold those assets, but it does not add any new productive capacity to the economy itself.
It just bids up the price of what is already there.
That brings us directly to the specific analysis in our RBI document. The report breaks down the 4 distinct channels through which broad money, which economists categorize as M3, is actually created in an economy. Let's walk through them because it shows that commercial banks aren't the only ones doing this.
They definitely aren't.
Channel 1 is what we just discussed, commercial bank loans. A bank credits a borrower's account, creating new money. But Channel 2 involves the government.
Yes, Channel 2 is funding the government. When the banking system, and this includes the central bank, buys government bonds, the system creates the money to purchase that debt.
So the government issues a bond, the central bank buys it with newly created money.
Right. The government then takes those newly created funds and spends them on public projects, salaries, or services. That injects that fresh money directly into the broader economy.
That makes sense. Then we have Channel 3, which is foreign currency conversion.
When foreign currency, like US dollars, flows into the country and is converted into local currency, in this case, rupees, the central bank, or the banking system, issues new local currency in exchange for those foreign reserves.
Which naturally expands the domestic money supply.
Exactly.
And finally, Channel 4, which the report focuses heavily on, dividend payments. When central banks pay dividends out of their reserves to the government, that also acts as a direct injection of newly created money.
It does. And it is important to remember that this entire system breathes in and out. Money is not just created, it is also destroyed or removed from the broad money supply when these processes reverse.
So when a borrower pays back the principal on a bank loan, that money is effectively extinguished from the system.
Yes. Similarly, if the government cuts spending that was financed by banks, or if foreign currency flows out of the country, the aggregate money supply contracts.
This leads us to the sheer scale of the RBI's recent dividend transfers to the Indian government, which falls squarely under that Channel 4 of money creation. The figures in the report are staggering.
They are among the largest central bank-to-government transfers globally right now.
In the 2024 fiscal year, the transfer was 2.11 trillion rupees. And then for fiscal year 2025, it was a massive 2.69 trillion rupees. To put that in perspective, that equates to roughly 0.75% of the nation's entire gross domestic product.
It is a massive amount of capital. And for the government, it serves as vital non-tax revenue. It helps them meet their budget targets and reduces both their revenue and fiscal deficits on paper.
without having to raise taxes or cut spending.
Exactly. It is a very comfortable cushion for policymakers.
Here's where it gets really interesting. Where exactly does a central bank generate trillions of rupees in profit to just hand over to the government?
To understand that, we have to look closely at their accounting methodology, because part of the income is straightforward and structural. The RBI holds foreign assets and it earns interest on them.
Right, standard interest income.
Yes, that accounted for around 1 trillion rupees in fiscal year 2024. And this is a highly profitable position because these interest-bearing assets are funded largely by non-interest-bearing liabilities, specifically the physical currency currently in circulation.
Okay, the interest income is logical, but the text highlights that a significant portion of the dividend comes from foreign exchange, or FX, gains. And this involves a very specific, almost tricky accounting practice.
He had a fascinating accounting quirk.
Before we get into the exact numbers, how does a central bank book a massive profit on foreign exchange if, as the report notes, they're actually buying more currency than they are selling?
Let's abstract it for a moment to make it clear. Imagine you were a collector, and years ago you bought a vintage baseball card for $5.
Okay, I have my $5 card.
Today, the market value of that specific card is $50. You decide to sell it, and you book a $45 profit.
A great return.
But on that exact same day, you also decide to buy 10 new baseball cards at $50 each, and you put them on a credit card.
So my actual cash flow for the day is highly negative. I brought in $50, but I spent $500.
Exactly. More money went out than came in. But according to your specific accounting rules, you only have to report the realized profit from the one vintage card you sold.
So I get to declare a huge win on paper.
Yes, and perhaps you even pay yourself a dividend based on that specific $45 profit. Meanwhile, the $500 you just spent simply increases your overall inventory costs for the future.
Apply that to the central bank's actual operations.
In fiscal year 2024, the RBI recognized 0.8 trillion rupees in FX gains. They did this by selling foreign exchange that they had accumulated years ago at a much lower historical weighted average cost.
Selling the $5 baseball card.
Exactly. Because they sold those specific dollars at today's higher exchange rate, they booked a large profit. However, during that same year, they were actually a net purchaser of $41 billion in the spot market.
So, just like the analogy, they were buying way more than they were selling.
Precisely. They had gross sales of $153 billion, which generated the accounting profit, but they had gross purchases of $194 billion.
And the accounting rules allow them to harvest valuation gains on the gross sales against their historical costs.
Yes. This means they can declare a profit and pay a dividend, even though their overall foreign exchange operations that year resulted in a net outflow of currency from their reserves.
But wait, if the RBI is technically booking a profit according to the established accounting rules, why does the report treat this as a vulnerability? Isn't a win on paper still a win for the government's budget?
What's fascinating here is the broader macroeconomic consequence. We are seeing a shift where governments utilize central banks as a sort of shadow piggy bank. While the accounting is entirely legitimate according to their rules, every single rupee of dividend paid by the RBI acts as channel 4 of money creation.
Because it is new money being injected into the system.
Exactly. No matter how it was justified on the balance sheet, once that dividend is handed to the government, it is spent into the economy. It fuels consumption, external demand, and ultimately adds to consumer and asset price inflation.
Which brings us to another tool the RBI uses aggressively that also expands the money supply. Open market operations, or FOMOs.
Yes. FOMOs involve the central bank directly buying government bonds in the open market.
The report notes that by January 2026, the RBI's HOMO purchases for that fiscal year reached a high of 6.4 trillion rupees. The text mentions this effectively offset the money drain that was being caused by net FX outflows.
This is a clear example of the central bank actively managing the system's overall liquidity.
Bridging the gap, essentially.
Right. At a time when domestic inflation was relatively low, the RBI stepped in with these large-scale purchases. The government had significant, massive borrowing needs to fund its deficit. But private investors and the open market did not have the appetite to buy all those government bonds at the low interest rates being offered.
So, by stepping in as the buyer of last resort through HOMOs, the RBI absorbed the debt and kept yields artificially low.
Yes. And tying this back to Perry Merling's framework, this is the central bank performing a balancing act between elasticity and discipline.
Let's explore that. Elasticity versus discipline.
Merling argues that central banks are designed to provide elasticity. They stretch the rules of the system, creating money and providing liquidity to smooth out crises or bridge funding gaps.
So the RBI's easing provided considerable elasticity here.
It did, which materially helped the government manage its fiscal arithmetic. But Merling also notes that elasticity always, eventually, meets the discipline of the market.
And how does that market discipline manifest when a central bank provides too much elasticity, when they just keep buying bonds?
It often manifests in the currency markets. By keeping yields low and injecting trillions of rupees through FOMOs, the central bank adds downward pressure to the rupee. This brings us to a foundational concept in international economics known as the impossible trinity.
Let's spend some time on that, because it is mentioned often but rarely explained clearly. What exactly is the impossible trinity?
The impossible trinity states that a country cannot simultaneously maintain three specific policies: a fixed foreign exchange rate, the free movement of capital in and out of the country, and an independent monetary policy.
So you have to pick two.
A central bank can only successfully choose two of those three at any given time.
Let's break that down. If a country wants free capital movement, meaning investors can bring money in or take it out without restriction, and it also wants an independent monetary policy to set its own interest rates to manage domestic growth,
then it must allow its currency's exchange rate to float and be determined by the market. If the central bank prints money to buy government bonds and keeps interest rates lower than the rest of the world, investors seeking higher yields will move their capital out of the country.
seeking better returns elsewhere.
Exactly. And that capital flight causes the domestic currency to depreciate.
What if they try to stop the depreciation? What if they want a fixed exchange rate and free capital movement?
Then they have to give up their independent monetary policy. If investors are pulling money out, the central bank has to use its own foreign reserves to buy its own currency to keep the exchange rate stable.
Which drains money from the domestic system.
Right. It effectively tightens monetary policy and raises interest rates, regardless of what the domestic economy actually needs at that moment.
So by aggressively using FOMOs to keep government borrowing costs low, the RBI is firmly choosing independent monetary policy. But assuming capital is relatively free to move, that choice inevitably places pressure on the exchange rate.
Correct. And the text points out a severe vulnerability looking ahead. The recent environment has been forgiving because inflation was relatively controlled.
But cycles always turn.
They do.
Yeah.
And in a higher inflation environment, the RBI simply cannot continue to deliver 6.4 trillion rupees in FOMOs and massive dividend transfers without exacerbating that inflation.
As the report warns, for policymakers, injecting money into the system is always a much easier sell than withdrawing it.
It is the classic central banking dilemma. Providing liquidity and low rates makes borrowing cheap and boosts asset prices. Everyone is happy, but when inflation rises, the central bank must withdraw that support.
They have to stop buying government debt and let interest rates rise.
Which is economically painful for borrowers and highly politically difficult for governments.
So what does this all mean? If relying heavily on central bank elasticity to fund the government is unsustainable over the long term, what actually needs to change? The RBI document proposes some specific structural shifts for the economy. Let's look at the first one.
The first major proposed structural shift is that the country must deepen its fixed income markets.
What does that mean in practical terms?
It means incentivizing far greater participation from everyday households, insurance companies, and non-bank investors in purchasing government debt.
And this loops right back to our very first point about the mechanics of money creation. There is a fundamental difference between a commercial bank buying a government bond and a private citizen buying one.
It changes the entire macroeconomic impact. Think about it like water in a closed pool. If you, a private citizen, buy a government bond, you take existing money out of your savings account and transfer it to the government.
The water simply moves from one side of the pool to the other.
Exactly. The total aggregate money supply in the economy remains exactly the same. No new money was created.
But if a bank or the central bank buys that same bond,
it is the equivalent of turning on a hose and pumping entirely new water into the pool. It expands the aggregate money supply.
So by shifting the burden of government financing away from the banking sector and onto non-banks, it limits broad money creation.
Yes, it enhances the central bank's policy flexibility and fundamentally limits those inflationary pressures.
That makes perfect sense.
Yeah.
And that leads to the second major structural shift the text demands. The government must directly reduce its revenue deficits.
Right now, those massive central bank dividend transfers are significantly compressing the headline deficit. Because the government is receiving trillions of rupees in non-tax revenue, its financial position looks much healthier on paper.
But it is a mask.
It is. It masks the underlying fiscal pressures. The fundamental gap between what the government actually collects in standard taxes and what it spends on its daily operations.
If we connect this to the bigger picture.
True macroeconomic resilience requires both everyday borrowers and the government to systematically reduce their reliance on banks and the RBI for financing. The system is currently running on the heavy elasticity provided by the central bank.
But that can't last forever.
No. When the inflation cycle inevitably turns and the discipline of the market reasserts itself, the central bank's support will have to recede. And as the author of our source warns, it may have to recede much faster than policymakers or the market are currently anticipating.
We have covered a massive amount of ground today. We started by looking at the functional reality of how banks lend, learning that they actually expand their balance sheets to create purchasing power.
Shattering that initial illusion.
Right. Then we examined the 4 channels of broad money creation and the specific, rather ingenious accounting methods that allow the RBI to transfer trillions of rupees in dividends to the government.
Which acts as that critical channel 4 of money creation.
Exactly. We explored how open market operations bridge the gap for government borrowing, but inevitably pressure the currency through the dynamics of the impossible trinity. And finally, we unpacked why shifting the burden of financing away from money-creating banks and onto non-bank entities is critical for long-term economic stability.
It really highlights how interconnected the financial plumbing is. Every policy choice, whether it is an accounting method for foreign exchange or a decision to step in as a bond buyer, ripples through the economy.
It eventually affects inflation, currency strength, and the overall stability of the entire system.
It is all connected.
And that brings me to a final provocative thought I want to leave you with, something to consider as you digest all of this. Perry Merling observed that our financial system is like a breathing organism, constantly expanding in booms and contracting in crises.
A great metaphor.
We just established that true economic resilience requires everyday households and non-bank entities to step up and take over the funding of the government to prevent excess money creation. But think about the broader implications of that shift.
It is a massive transfer of responsibility.
Exactly. If these proposed structural changes succeed and everyday citizens become the primary holders of government debt, does this shift the ultimate systemic risk away from the highly regulated halls of the central bank and place it squarely onto the shoulders of the everyday investor?
That raises a vital question. By solving the macroeconomic problem of inflation through money creation, a society might be inadvertently democratizing the financial risk of its own national debt.
Something for you to mull over. Thank you for joining us on this deep dive. We appreciate your drive to look past the surface and truly understand the mechanisms that shape our world. Until next time.